Let me ask you something. What if I told you that right now, as you're watching this video, gold is trading above $5,000 an ounce, and the biggest banks on Wall Street are projecting it could hit $6,000 by year's end? And what if I told you that most beginner investors are just watching, sitting on the sidelines, thinking they're too late? They're not, and neither are you. Welcome to what I genuinely believe is one of the most important beginner investing videos you'll watch this year, because today we're breaking down exactly how to understand, position yourself in, and potentially profit from two of the hottest commodities of 2026, oil and gold. I'm going to cover why these assets are moving, what the big money's doing, the 5 specific ways you can get exposure right now, even if you're starting with just a few $100s, and the mistakes that'll blow up your account if you're not careful. Before we talk about how to profit, we need to understand why these assets are where they are. Because if you just follow a trend without understanding the reason behind it, you're not investing, you're gambling. So let's rewind a little. Gold had an absolutely insane 2025. We're talking a 55% surge, climbing past $4,000 an ounce for the first time ever. That's not a blip, that's a structural shift. What caused it? 3 big forces. And here's the thing, all 3 are still in play right now in 2026. Geopolitical chaos. We've got conflict in the Middle East, tensions between the U.S. and Iran that have disrupted shipping lanes through the Strait of Hormuz. When the world feels unstable, money flows into assets that governments can't print or freeze. Gold is the ultimate I don't trust anybody asset, and right now, a lot of people don't trust anybody. This is the one most beginners don't know about, and it might be the most important. China's central bank has been buying gold for 15 consecutive months. Russia, Turkey, India, Poland, central banks around the world are quietly, steadily moving their reserves away from U.S. dollars and into gold. J.P. Morgan is projecting around 190 tons per quarter of central bank buying through 2026. That's massive, consistent demand. Why are they doing this? 2 words: de-dollarization. Countries are hedging against the dominance of the U.S. dollar, especially in a world of sanctions and trade wars. Gold is nobody's liability. The Fed and interest rates. Here's the relationship you need to tattoo on your brain as an investor. When interest rates fall, gold rises. Why? Because gold doesn't pay dividends or interest. When rates are high, people prefer bonds and savings accounts. When rates fall, gold becomes more attractive. And right now, markets are pricing in multiple Fed rate cuts this year. That's rocket fuel for gold. Now, what about oil? This is where it gets more nuanced and, honestly, more interesting for savvy beginners. Unlike gold, oil in 2026 is facing a supply glut. Goldman Sachs projected Brent crude averaging around $56 a barrel, lower than many expected, because the market is oversupplied by about 2 million barrels per day. OPEC Plus has been slowly bringing production back online. Non-OPEC supply, especially from the U.S., is growing 3 times faster than demand. So here's the thing. Lower oil prices can actually be a profit opportunity too, just in a different way than gold. We'll explain that in the strategy section. The point is, these 2 commodities are driven by different forces in 2026. Gold is in a structurally bull market. Oil is volatile and cyclical. Understanding that difference is what separates smart beginners from lucky ones. Let's get into the gold numbers, because I think the forecasts for this year will genuinely surprise you. J.P. Morgan, one of the most respected commodity research teams on the planet, is projecting gold averages around $5,055 per ounce in the final quarter of 2026, potentially rising toward $5,400 by end of 2027. Goldman Sachs has set a year-end target of $5,400. Wells Fargo is calling $6,100 to $6,300.
Deutsche Bank sees $6,000, driven by what they call persistent de-dollarization. And at the most aggressive end, Blue Line Futures and BNP Paribas both have $6,000 targets. One analyst at Yardeni Research, no joke, is projecting $10,000 gold by end of the decade. Now, not everyone is a bull. Some banks see gold pulling back. The consensus among 30 Reuters strategists sits around $4,746, so there's genuine debate. This is not a sure thing. But here's what is certain. Gold has already made a historic move, and the structural drivers, central banks, de-dollarization, geopolitical risk, Fed policy, are not going away anytime soon. So the question isn't really, will gold stay high? It's, how do you participate? And that's what we're about to get into. But first, let me quickly explain the oil opportunity, because it's different and honestly a bit more accessible for absolute beginners.
The global oil market is oversupplied. Goldman Sachs projected a surplus of about 2 million barrels per day. Non-OPEC countries, especially the U.S., are pumping more than ever. And demand growth, while positive at around 1.2 million barrels per day, hasn't kept up. That's why Brent crude was projected to average around $56 a barrel, compared to the 70s and 80s we saw in years prior. Now here's where the contrarian opportunity comes in. Low oil prices hurt oil-producing companies in the short term, but they also, 1. Make energy stocks potentially undervalued. When a stock is beaten down because of macroeconomic headwinds, not because the company is bad, that can be a buying opportunity. 2. Create a rebound setup. Goldman Sachs actually projects that oil prices bottom out in mid-2026 as markets start to see rebalancing, meaning the window to position yourself before the recovery could be opening right now. 3. The geopolitical wild card. The Strait of Hormuz situation, conflict in the Middle East, Russian supply dynamics, any one of these could flip the script overnight. Oil is the most geopolitically sensitive commodity on Earth. Supply disruptions can spike prices 20–30% in days. The smart play with oil in 2026 isn't go all in. It's get exposure intelligently, position for a potential recovery, and don't overextend. Let me now take you through exactly how to do all of this.
All right, this is the section you came for. 5 specific ways beginners can get exposure to gold and oil in 2026, from the safest to the more aggressive. I'll explain each one, what it costs to start, and who it's best for. Method 1. Gold ETFs, the gateway drug, and I mean that positively. ETF stands for Exchange Traded Fund. Think of it as a basket that holds something valuable, in this case, gold, and you buy a slice of that basket on the stock market, just like buying a share. The 2 most popular gold ETFs are GLD, the SPDR Gold Shares, and IAU, the iShares Gold Trust. IAU has slightly lower fees, which matters over time. When you buy a share of IAU, you're essentially buying a fraction of physical gold held in a vault. No storage, no security headaches, just exposure to the gold price. Minimum to start, you can literally start with 1 share, whatever the current price is, often under $100 for IAU. Best for total beginners who want gold exposure without complexity. Risk, moderate. You're exposed to gold price swings, but you're not leveraged, so you can't lose more than you put in.
This is what your grandparents did. You go to a reputable dealer, the U.S. Mint, APMEX, JM Bullion, and you buy actual gold coins or bars. American Gold Eagles are the most widely recognized. The upside, you own something real. No counterparty risk, no brokerage, no institution stands between you and your gold. The downside, storage costs, insurance, and the spread, the gap between the buying and selling price, can be significant for small purchases.
Best for people who are worried about systemic financial risk and want a physical hedge, people who want to hold wealth outside the financial system. Minimum to start, a gold coin, 1/10 ounce American Eagle, runs roughly $400 to $600 depending on the gold price. Method 3. Gold and oil mining stocks. More risk, more reward. Here's where it gets spicy. Instead of investing in the commodity itself, you invest in the companies that dig it up. And mining stocks are historically more volatile than gold itself. They can move 2x, 3x, even 5x the underlying commodity move. Why? Because a gold mining company has fixed costs. If gold goes from $3,000 to $5,000, the cost to mine it doesn't double. Their profit margins explode. That's called operating leverage. Well-known gold miners include Newmont, NEM, Barrick Gold, GOLD, and Agnico Eagle, AEM. For oil, companies like ExxonMobil, Chevron, and Pioneer Natural Resources are household names. You can also buy the GDX ETF, VanEck Gold Miners ETF, if you want diversified exposure to multiple gold miners without picking individual stocks. Best for investors who understand stocks, can handle volatility, and are looking for potentially larger gains. Risk is higher. Mining companies have company-specific risks on top of commodity price risk. Method 4. Commodity ETFs for oil. XLE and USO. For oil exposure without touching futures contracts, which are way too complex for most beginners, there are two main ETFs. XLE, Energy Select Sector SPDR Fund. This holds major U.S. energy companies, ExxonMobil, Chevron, ConocoPhillips. When oil prices rise, these companies profit, and XLE rises with them. USO, United States Oil Fund, tracks crude oil futures more directly. It's more volatile than XLE and has some quirks with how it rolls contracts over time that can erode value. Understand it before using it. Best for investors who want straightforward exposure to the energy sector, positioned for a potential mid-2026 oil rebound. Minimum, 1 share of XLE or USO. Very accessible. Method 5. Precious metals royalty companies, the sneaky smart play. This is the one most beginners have never heard of, and it might be the most elegant strategy on this list. Royalty companies like Franco-Nevada, FNV, Royal Gold, RGLD, and Wheaton Precious Metals, WPM, don't mine gold themselves. They provide upfront financing to mining companies in exchange for the right to buy a portion of future production at a fixed low price. So when gold goes up, they profit massively without the operational risks of actually running a mine. No labor strikes, no equipment failures, no cost overruns. They're essentially a toll road on gold production. These stocks have historically outperformed both gold and gold miners over long periods, and they pay dividends. Best for slightly more sophisticated beginners who want gold exposure with reduced operational risk and a dividend income stream. All right, I'd be doing you a disservice if I only talked about the upside. Let me tell you the 3 mistakes that'll blow up your commodity investing strategy in 2026. Mistake number 1, going all in because of hype. Gold is at record highs. That means it's already had a massive run. Buying everything you have after a 55% rally is called buying the top. Classic beginner trap. The smart approach is dollar cost averaging, putting in a fixed amount regularly regardless of price. This takes the timing pressure off completely. Mistake number 2, using leverage you don't understand. Platforms will offer you 10x, 20x, even 100x leverage on gold and oil CFDs. This means a 1% move against you wipes out 10 to 100% of your money.
According to industry data, 71% of retail clients lose money trading leveraged commodity products. If you're a beginner, stay away from CFDs and leveraged ETFs until you have real experience. Full stop. Mistake number 3, ignoring the why and just chasing price. Gold could pull back. Oil could stay depressed for longer than expected. Unexpected Fed hawkishness, a geopolitical resolution, a strong U.S. dollar, any of these could pressure commodity prices. If you don't understand why you're holding something, you'll panic sell at the bottom. Know your thesis, know your timeline, know your risk.
So let's say you're convinced. How much of your portfolio should actually go into gold and oil? Most financial professionals suggest keeping commodity exposure between 5 and 15% of your total portfolio. If you're more aggressive and believe strongly in the macro thesis, some will go up to 20%. But for beginners, I'd say start at 5 to 10% and build from there. A sample beginner allocation might look like this: 5% in a gold ETF like IAU, your core gold position, low maintenance; 3% in GDX, mining stocks for amplified gold exposure; 2% in XLE, energy sector exposure for the potential oil rebound. That's 10% total. The remaining 90% stays in your regular diversified portfolio, stocks, bonds, whatever your strategy is. This approach means if gold and oil tank, you're not ruined. If they rip higher, you're meaningfully participating. That's the balance. Gold is at historic highs, and the structural story driving it, central banks, de-dollarization, geopolitical tension, a dovish Fed, is not over. Smart money from JP Morgan to Goldman Sachs is still bullish. That doesn't mean it goes straight up, but it means the trend has substance. Oil is more complicated, oversupplied in the near term, but with a potential rebound set up in the second half of 2026 and always one geopolitical shock away from spiking. For beginners, the path is clear. Start small, use ETFs to get exposure without complexity, avoid leverage, and understand what you own and why you own it. You're not too late. The smartest investors aren't the ones who called the exact bottom. They're the ones who understood the thesis, positioned themselves thoughtfully, and stayed patient. If this video gave you clarity, do me a favor and drop a comment below telling me, are you Team Gold, Team Oil, or both? I read every single comment. And if you want a follow-up video on how to actually open a brokerage account and buy your first ETF step by step, let me know down below. I'll make it. Like the video if it helped. Subscribe if you want more. And I'll see you in the next one.